That's where it needs to be, right here. So what we've done is we've taken out this short-term low, and we created an initial sell-side liquidity pool, and we went above this short-term high, and we created an initial buy-side liquidity pool. Okay, why is that classified like that? Why am I labeling that high, and why am I labeling this low? And why is it initial buy-side and initial sell-side? Because we've opened a new day at 6 o'clock. We created the inefficiency that is the new day opening gap. It's moved away. That's the first thing we're looking for. It needs to move away from it. It does so. What is it going to do? It takes out the short-term buy side. Does it go back down below the new day opening gap? Yes. Why? Because the algorithm is calibrating and setting, and this is visually representing how the algorithm engineers liquidity. It takes a short-term pool of liquidity out and then goes to the opposing side below this low. Now there's a new low and a new high after 6 o'clock. You see that? This is the initial high and the low that every trader that trades at that moment is going to refer to for where their stop loss is going to be. So now we have initial sell side liquidity for the day and initial buy side liquidity for the day. Outside of those two reference points, then you look to the left and say, okay, where are the larger pool of liquidity? Well, obviously it's here. So if we have that, once we broke through here, we have to see it do another characteristic with the new day opening gap. We have to move away from it initially, go to a short-term high to take liquidity out, which it does here, and then drops down below, crossing over the new day opening gap. So this is where you want to see it coloring outside the lines. Okay. So many times I've introduced ideas and talk about specific PD arrays. And when I tell people, annotate this level, annotate that level, this is a fair value gap. This is an inversion fair value gap. This is, something else. And as soon as someone that's watching it sees it cross through, they think, aha, it didn't even hold. This is the logic behind it, okay? You want to see it trade away from the new day opening gap as it formed. And if it goes up, it's taking a short-term high out. And then you want to see it cross back over it and seek a short-term low, which is what it's doing here. Once it does that and it crosses back into it, again, we have now set initial buy-side liquidity and initial sell-side liquidity. Now you're going to wait. What are you waiting for, ICT? When's the time of day for Asia? 7 o'clock. Okay. Go over here to the vertical line. Does this seem complicated yet? Let me know. Let me know if this is complicated, okay? Because this is really simple stuff. Really, really simple stuff. So now we have what happened. The market crosses back above new day opening gap. Does it take out the low here, right there? As we're heading into 7 o'clock, what is it doing? Is it moving to this low to challenge this sell side liquidity?
Absolutely not.
So what is it doing here energetically here? What is it doing?
And it's placed on the upside.
Right. So it's crossing over the new day opening gap. And then at 7 o'clock, what does it do on the 7 o'clock candle? Look close. Let me take this away for a second. What do you see it do?
And it dips back into it just slightly.
It retrades to the new day opening gap that was formed right over here. You see it touching that?
Sure.
So if it's going to go back to that after having displacement here, it's already set the initial boundaries for the sell stops and the buy stops. So the algorithm is giving the signal right here. Now we're inside the element of time. Dave. So the market should displace above this high, relative equal highs, challenge the initial buy side liquidity, and will test and hold to see if it can run above this high. So if we look at how the price opens on this candle, it drops back down and touches and retrades to the high of that new day opening gap. So everything's in motion. Everything is set. We did not have an interest in going back below the initial sell side liquidity that took out this low. The key things are this. We're gyrating around the new day opening gap. You want to see this. But when it comes to time, 7 o'clock is your time in Asia. The algorithm will come online, and you'll see buy programs and sell programs begin right at 7 o'clock or just after it. Okay, and you're only really interested in until 9 o'clock. So if you're a working class hero in the United States, or if you're overseas and you want to trade in this time of day, your key times are 7 p.m. New York local time to 9 p.m. New York local time. So it's a small little window of focus. You don't have a whole long, it's not 4 hours. It's a very small segment of time. Okay. So anyway, the down close candle in here, it trades down, touches the top of the new day opening gap. And now because it's 7 o'clock, it's proven that it's not going to go down here. It has no interest in it. And this run here, this right here, that is indicative of that it wants a run. So because it's doing this buy side imbalance, sell side inefficiency, I would have no interest, as you saw last night. I'm not interested in seeing it come back down into that gap. So what does that make this gap? It makes it a breakaway gap. And so if it's going to break away from running higher and not going lower, what's it going to seek? This short-term high. I want to see, does it have momentum and speed in which it takes that relative equal high out? This high and this high. When it trades there, which it does right there, it pops through it real quick and then comes back half of this range, consolidates around it, boom, runs into initial buy-side liquidity. So now I want to see this, treat it as rocket fuel. You don't want to see it go up and then go right back in, because what that was is it's a fade. That's your turtle soup. It's a fake out. What we're looking for is we want to see like a nitrous oxide injection of strength, speed. When Dad does the recordings when I'm trading, and I'll type out and say, I want to see speed and magnitude. I want to see distance. That's because I'm expecting these elements in price action. At that moment, I want to see that being visible in price. And you can see it happening here. And then we gap up. Where this candle closed, it gapped up here. When we trade back down into that, right there, that is an entry as well. And you'll see those things as we start going to the charts live. I'll point them out to you. And when we take screenshots, this is an actual wonderful buy. And then we start to roll up here. Then we see the classic volume imbalance and retrade to it there. And that's another buy. And then you have this big pop here, which we watched happen. I mean, we both were like, yeah. And when it happened, I was like, yes. Well, it runs up there and took the buy side here. So visually, you can see how in this candle, I'll put that right over top of it. You can see the entry right there. And what I was aiming for, as I wanted to watch when it opened and traded down, I wanted to see it get below the body of that down close candle. I don't care where in the spectrum of that wick, because that's a discount wick. I'm buying that order block because I understand it's an order block. Everybody else will simply say, well, you got to look to buy the down close candles. And that just shows that they only listen to my very first introduction to an order block because they don't understand what an order block is. So I want to be in the discount element of that down close candle, and I want to be entering below its body. In this case, it's the close. So if you look up here in the upper left-hand corner, you see the close. It says 18,560.00.
Yes, sir.
I want to be buying below that, at it or below it. And my entry was 559.75. So that's pretty good. And then it rallies. And when you have this break like this, your stop loss has to be below the consequent encroachment of the new day opening gap.